Hey there, welcome back to Macro Micro. Since the Fed hiked up interest rates to more than 5% last year, the financial world has been keeping an eye on how interest rates affect companies' abilities to pay back their loans. Today, we delve into this topic by looking at one indicator, credit spread, which is a crucial gauge for corporate default risk that can offer clues to investor confidence and stock market trends. But first, what exactly is credit spread? Simply put, it refers to the difference in the yield between two debt securities. The credit spread we'll look at today is calculated as the yield on BofA Merrill Lynch CCC-rated high-yield bonds minus the 10-year Treasury yield, the former representing junk bonds, and the latter commonly known as the risk-free interest rate. Now, what does this difference tell us about corporate default risk? When the economy hits a rough patch and businesses start to look shaky, heightened corporate default risk causes investors to pull their money out of high-risk assets. Consequently, the prices of high-yield bonds slide, pushing their yields higher and thus widening the credit spread. This had been the case in past economic downturns, such as the dot-com bubble in 2002, the financial crisis in 2008, and the COVID-19 pandemic in 2020. We can see in the chart, as the credit spread rose, indicating more corporate defaults, the S&P 500 fell in tandem. But when default fears ease, high-yield bond prices recover, yields decline, and the credit spread narrows. On the stock market front, investors regain confidence, pushing stock prices back towards levels that reflect their assessment on how well companies are doing. In a nutshell, a widening credit spread signals growing concerns about companies not being able to pay back their loans, while a narrowing spread means investors are not too worried. Fast forward to the present, we can see the credit spread in the US is not on the rise, but remains relatively low at around 9 to 10%, suggesting low default risk and minimal chance of a credit crunch in the near term. For more details and the full article, visit our website. Thanks for watching, and we'll see you next time.